Hi, good evening, everyone. Good to be here on the stage. You saw my colleagues moderating the session, and just after KK sir's session, I think we have to match to that benchmark, I must say, because he gave a very unique perspective, very unusual thoughts, and kind of told us how has been the journey of a CFO's been. So very interesting. This particular session is again I must say, very exciting because startups are the most integral part of today's ecosystem. And a small conversation that I remember, and that's why we crafted this particular session, is I was talking to an investor very recently because you're doing lots of stories on whether funding winter is real. I will come back to that question also to all of you a little later. And this investor told me, you know what happened? I received a lot of pitches from the startups, but one startup, maybe 2, 3 young boys came to me and they says, we would like to raise this much money. And he says, fair enough, but where is your product? So the startup said, you give us the fund first, then we'll develop a product. So the funding became to this level that startups even started expecting that they will get money or funds even to develop a product, right? So that's where the immediate question comes, whether the funds which the startups are raising are real, or are they really building a business value versus the traditional companies, building their values. And that's why we decided to specifically drill down and find a in-depth conversation, do an in-depth conversation on building value versus building valuations. So that's the topic of this particular discussion. As you know that we have been discussing the next paradigm in the leadership. And here the next topic that we're taking is the valuation. So thank you everyone for joining us. And let's discuss. So as we discussed earlier, that we'll separate this into 2 parts. One is the common questions and then the separate specific questions. So my common question to all of you is the dilemma or the dilemma over building value versus building valuation is real? And I will start with you, Bittu.
Thank you, Amol. And thank you, ET, for inviting us all here. Interesting panelists. I think both are, interrelated in a lot of sense. Building value and valuation, to my mind, goes hand in hand. What is valuation? Valuation is an economic number to what your business looks like, the entire value of your business. And how do you kind of reach to that economic number? Of course, I think Mr. Ji in his keynote also laid it down very clearly. You have to build the organization on a lot of strong fundamentals, the financial acumen, the business story, the sustainability of business and the sustainability of your financial results. Build a strong balance sheet. I think when you build a good story backed by decent numbers, your valuation, kind of comes up. And to get to those valuations, I think value creation in itself is the first step. So I think both go hand in hand, and that's how we kind of accelerate. So,
okay, sure. Chirag?
Yeah, first of all, thanks Amol and ETCFO team for inviting me and having me here. Glad to be part of this distinguished panel. I completely agree with Bittu here. The value, when building valuation and building value goes hand in hand, it's something that we can relate with profitability and growth. Both goes hand in hand. But there is certainly a subtle difference between the two. And actually, that difference is what leads to this conundrum of building value versus building valuation. So, if to break down this conundrum, we'll have to kind of understand what's the characteristics of the valuation or the foundation on which the valuation has been built up. So if it's purely on extreme growth and with no proper metrics on unit economics being there on at the foundation level, or no visibility, the P2P, that should clearly be visible in the business models that we are evaluating. So if that's not there, then that's a concerning point, and that kind of sets in the dichotomy between the two, the valuation and the value. So I think that's one of the important ingredients to kind of assess what's the real value Because if you don't have this parameters of unit economics or profitability or path to profitability, LTV to CAC, what we say is lifetime value to CAC ratios, if those are not aligned, then probably that's concerning, because your real value is far more lesser, or there's basically a gap between the real value and the actual valuation. So that's a concerning thing.
Sure. Rahul?
Thanks, Amol, and thank you, ET, for inviting me on this forum. So, see, my view will be slightly different. So, see, as per what I learn and understand, valuation always follows the values. So, while we talk about values, valuation, last year you have seen too much of article coming on a daily basis, 100 unicorns, 200 unicorns, US ahead of us, China ahead of us, government coming with various numbers day in, day out, that too many private entities has gone into such large unicorns. So, see, creating value is more important than creating a valuation, and it always follows the value. And we talk about values, I think it has 2-3 pillars, which is very important. Creating the values for the customer, creating the values for the stakeholders, creating the values for the investors. When we say stakeholders, employees comes first. So, creating a product, creating an ecosystem which is sustainable, stable revenue, cash flows, those creates environment where you have sustainability as well as the value for the organization. Yes, rightly said by Chirag that profitability and other metrics are important, which derives the valuation, but at the initial stage, when we look at too large of growth, which is very different from a traditional industry and where we startups comes into picture with a disruptive product as well as the growth. Yeah, some initial years you have the hit in terms of profitability, but when you talk about the investors, while they're coming on the board, they look at the market fit, the same environment in different growing countries, as well as how it is going to shape in the future. Like what will be the real cash flow, how the market size fits, the audience you are looking at, those things comes into picture while deriving on evaluation. But important thing is creating the values for all three stakeholders. Thank you.
Sure, Rahul. Abhinav?
Amol, very valid question. And first of all, thank you for having me here. I agree with the other panelists. Values create value. You have to have a strong product, strong governance, and strong team in place. And if you put all these three, profit is a derivative. Traditionally also, companies were valued at profit multiple. Today also it is valued at profit multiple only. There's no change in the valuation process. Initially, when you are building something, it takes some time. There's a roadmap to profitability. On day one, company might not be the profitable, but there's a roadmap. At certain point of time, you will be profitable. And based on that profitability, company gets valuation. The most important, last year, if we have witnessed in FY21, we received $40 billion in terms of funding for startup. And earlier H1 of FY21, we received $19 billion. So there's a belief in Indian ecosystem that these startup can create value in future, because this is significant amount we have received. But all of a sudden, because of tussle between East and West in Russia-Ukraine war, led to inflation, and which led to increase in interest rate. And that made the ecosystem deprived of the capital. But again, most of the startup are solving real life problem, be it Oyo, be it Swiggy, or be it PharmEasy. All startup are solving real life problem of a consumer. Or if there might be some inefficiencies in the existing system, which we are taking out of the system. And in this journey, this requires certain amount of time to reach to our goal post. So in this period, because of funding winter and all, India, the fund inflow in form of capital became relatively difficult for startup, but this helped the entire ecosystem to reach or to target toward profitability, or to divert roads toward profitability and shift gear for profitability. But in this all, India will be benefited a lot because now again global across the globe, everybody is going for China plus one, and this plus one will give a lot of benefit to India. Of course, will not get uh, funding quantum what China is getting, but a significant chunk will come in India. And this is a litmus test for all the players to prove their business model. We all are mature enough, we all understand. Most of the startups or settled startup are raising funds for building the business, growing the business. Nobody is raising funds to run the business. And this pivot help us or will do filtration in the ecosystem as well. But post this sustenance, capital for these startup will become relatively easier.
Sure, Abhinav. Arvind?
Good evening, everyone. Maybe a little bit more energy in the room. It seems that valuations are not exciting at this point in time. But yeah, good evening. Thanks, ETCFO. Thanks, Amol, for getting me in on the panel. And I think my views are not different than the co-panelist here. And valuation is never the goal. Valuation is always a derivative or an outcome of a strong, consistent performance on various parameters. So it's a combination of performance and with the potential of the business, right? So in the short term, valuation may vary depending on investor sentiment and their appetite. A lot of macro factors, economic outlook. We have a lot of uncertainty and volatility in the environment, inflation, cost of capital going up. All of that has impacted valuation in the short term. But it's for sure that in the long term, it is a function of performance and potential. Now, performance can be measured in various ways, but it can't be only revenue. It has to be revenue and profitability, and in fact, it should be cash flow and ROCE. And the potential is how much headroom of growth you have, how big is your TAM, and what stage of penetration of your business model you are. All of this will determine the valuation in the long run. So there is no dilemma. In my view, valuation has always been an outcome and derivative of great performance consistently.
Sure. So, friends, we have look at the panelists here. We have really different companies. Somebody's into finance, doing merchant transactions. Somebody's into pharma. You can buy the medicines at a discount rate. Somebody's into logistics. You can dispatch all your goods and services. Somebody's into soul store. I'm sure you must be buying your lifestyle T-shirts and all those products because the soul stores are everywhere now. And after doing all this, then you can have a party with the Satori and the Indonesia and everything, right? So, in fact, we were in fact asking Bittu whether he could give some coupons, who can ask a better question and can have a direct flight to Nashik and have an enjoyable treat at the Sula Vineyards.
I thought you were asking for some carrots as well.
Yeah, sure. Or
Are we allowed to do that?
interesting. But how many people are here specifically from the startup? Anyone here from the startup? Okay, sure. So keep your questions ready. I will certainly come back to you. Not on whether the Paytm will make money on the valuation sides specifically, because these people are also in the line of making and hitting the stock market, I'm sure, very soon. So let me get into some specifics. And Bittu, I will start with you because you are the one who listed a company very recently. I'm sure the others will soon follow that path or must be thinking about it. I will not ask them when they are going to do it or whether they are already in the process of DRHP. But how has been the experience after listed the company? I know you are not as young as the other companies, sitting here, but it's a dream for every startup, every company to get listed. And before getting listed, you think all the time about the valuation. But now, is it that the first thing that you do, when you wake up, look at the chart of the previous day close and pray to the God that let the stock go up? How your day has been changed now?
Very interesting question, actually. And let me tell you, while you said, right, we are almost a 2-decade-old company, but we are and we were always very much like a startup. We operated, we thought, we worked in our day-to-day, you know, we've been a startup by our spirit. So yes, a 2-decade-old company listed just a few months back. I think the post listing is something which is clearly driven by how you did the pre-listing, you know. And if you were to put the right, building blocks in place when you prepare for your listing, your life post listing is not, you know, very difficult or very different or whatever. And I'll come to the share part also. So I think what was key for me as a CFO for Sula and in the journey of preparing for listing or an IPO was to put most important, to put the right team in place. You know, very important to have a very solid, razor sharp team to work for you, because these people are going to, like, you know, pick up one verticals each and going to drive the entire process of the IPO, and the process is very daunting. You know, it's quite stressful. The deadlines keep changing, and every deadline is very, you know, constrained. So, and there is a lot of compliance requirement. So you need the team to get the entire governance and compliance in shape. You have to do a lot of, and it becomes even more difficult if you are a 2-decade-old company, because you have got secretarial records dating back, you know, 20 years. So you have to go back to all of that, you have to dig all of that, bring everything, put everything in order, and there have been, you know, multiple people changes happened during the so many years. Data may not be archived properly. A small company growing may not do that. And hence, a very important message to each one of you: digitization, archival, record maintenance, and all these things are very important if there is a vision of going public at some point of time. So when you do all of that and then you get to that process, you go through all the regulations. You have LODR, you have the ICDR, and there are lawyers, and there are the bankers, and everybody is kind of teaching you or hand-holding you on, or maybe a lot of times scaring you of what to do and what not to do. So you go through the entire process. You do your audits, you do for DRHP, you have a set of financials, then for RHP you have one. And your team is ready to deliver that kind of performance even after you listed. So that's your practice ground. You do your practice, you do your listing. Once you're listed, your key focus remains and continues to be governance. Your key focus remains disclosure. You have to be very clear in terms of what information can be there in the public domain, or if it has to be there in the public domain, who has to be notified first. So compliance, governance, these become very key. From a business point of view, and deriving from what we just spoke in the last question, is sustained business values. You know, you have, when you went ahead and you sold, or you kind of, put your company or your company prospective investors in the roadshow, you spoke about a trajectory, you spoke about how you, or rather even without giving out forward statements, you did give an understanding of how the industry, the addressable industry is looking like. What is your market share? How you're going to grow this market? How you're going to penetrate? How you're going to do what you're going to do, or what you have done in the past, and how it is an indication of how you're going to move. So sustaining those results, you know, the key question that keeps coming up to me again and again, and not just from the investor community, but also from media at certain times, is, you know, how are these margins going to be sustainable? Are you going to keep these margins? Or do you see, you know, certain regulations that are going to impact you, and hence these margins going down? The story that you build at the time of IPO is the story that you'll have to continue with, and you have to live with it in terms of how you deliver that, right? And that is the important challenge. So when I would not want to look at the share market prices on a daily basis, because that's, again, as we said, it's short term. You know, when you look at it on a daily basis, there may be several other factors which will influence how the prices keep going up and down. There will be some random news coming here and there. People may react, people may not react. It may go up, it may come down. For what you offer to the shareholders is sustained business value. You have to give the shareholders a trajectory. You have to give your long-term shareholders a decent return. And for doing that, you need to have a sustainable business in place, which you had promised to the investors, and you have to stick to that. I think these are broadly the aspects that one will have to look at once you are listed.
Sure.
Thank you.
Noted your points, Bittu. quite meaningful one. And yes, the first question that we were asking, most of the companies or startups got listed was about the profitability. And that's why few of the people stopped giving interview to us because they realized that we are asking only about profitability. But thanks for adding that. So I have a couple of questions and some specific questions also, but let me involve all of you also. So if anybody has any specific questions here to any panelist, be very, very specific and stick to the only topic. Yes, can we have a question? Yes.
Hi, I have a question for PharmEasy.
Can we have a mic there? Or maybe I will just move to Chirag and then till the mic comes, I will come to you. So Chirag, then let's move forward with the conversation. So most of the startups are also into the profitability and expanding mode right now. So tell us the challenges that you face specifically when you're building value by expanding and looking at the profitability.
Sure. So most startup companies, when they kind of expand, they come across several challenges. I'll kind of list down three main challenges I think which all startups would come across. You can kind of categorize it as CAR, C-A-R. C stands for capital. A is for agility to the external circumstances or external environment. R stands for rationalizing of your spends. So starting with capital, there are two constraints there. First is adequacy of capital, and second is the right mix of capital that you need to have when you're expanding your business. So adequacy of capital is always going to be a constraint. You will have minimal reserves in startups, and you'll have to make some tough calls of letting go of few opportunities because you can't invest in all these segments that you want to. I mean, because you have limited reserves, you'll have to kind of take those decisions where to invest and what to let go of for now. Second is the right mix of capital. So quite often I've seen, startup companies depending very heavily on equity funds. But it's important to have a good mix of debt equity. Also in debt, it's very important. I've seen startup companies or small size companies having on their balance sheet venture debts, which comes with clauses of warrants and subscriptions. If you look at the effective cost of capital for those kind of funds, it's upwards of 25% or 24%. That's going to be detrimental on your P&L. They will act as a deterrent for you to generate positive cash flows. Hence, it's very important to kind of choose the right mix of capital. You can look out for alternatives like if your requirement is specific to making payments to the vendors, you can look out for vendor financing. Or maybe something on, if it's more specific to inventory, maybe leasing, any kind of lease models or lease financing. So it depends on your requirement, and that accordingly you should fix in the correct mix of capital that's going to suit your business model. So moving on from capital, being agile to the external circumstances is very critical. So if you look at any successful company, any companies which have kind of gone through all the troubles and all the good times as well, you'll see they have a very good skill set to shift their momentum between growth and profitability depending on the external environment. So, in times of economic prosperity, all of us are expected to achieve growth, go for that high-level growth, and that's possible in that kind of an atmosphere. But it is in times of slowdown where the profitability matters. And it's a current situation where it's a global slowdown, and today investors are shying away from investing in companies where there is no profit, even in startup companies. So that's the reason we are using this term called winter funding here. So it's very important to shift your focus to profitability and to have that and for you to be shifting your focus, you'll have to kind of have that path to profitability, which I was referring to in the earlier question to Amol. So yeah, so that's the second part. Third is rationalizing of your spends. So quite often in startup companies, for example, marketing spends, it's very natural for a startup company to get inclined to the recent marketing techniques or recent marketing kind of spends that are currently being done on the social media campaigns on or any kind of a digital media platforms, you will end up spending there and you'll realize, oh, this is not now making me fetch the revenue which I had actually targeted. So your LTV to CAC, which I was referring to in the earlier question as well, suffers. And if that's happening, it's going to be difficult for you to kind of then ensure that your unit economics are holding good to the holding good, basically. So in order to, I mean, it's important that you're able to rationalize all of the spends and get a good number on the P&L by focusing very minutely on all of this smallest of the spends that you're making.
Sure. Noted your point, Chirag. Yeah, we have a mic there. Quick question, please. It's there. Yeah.
Yeah, hi, I'm Ruchika from Novama Wealth, and we are big investors into your company. So my question is, what value or what valuation have you created that the stock price has corrected and the listing is nowhere in the picture? So when will it get listed?
Oh, I'm sorry. I didn't know the investors are sitting in the conference and showing questions like this.
See, I'll put it this way, see, currently we guys are touching almost 8% of the entire country's healthcare market. And see, well, we are break even, we are EBITDA positive. So that way we don't require capital. But still, there was clear roadmap how things will evolve, and that is in place. Very soon we'll be going for listing. We are waiting for right environment to go for it. But we have strong investors who have faith in us, and they want us to go a little longer from listing point of view.
Sure, thanks. Let me do some market check here. How many of you are using PharmEasy? Wow, interesting. How many of you are using SoulStore? Okay. And how many of you are using Xpressbees?
You will not find direct customer, Amol.
Yeah, I'm just. How many of you are aware about PayU? I know PayU is also directly. And how many of you are aware about Sula?
We have large customer base.
Quite interesting. I do not know whether all of you are in the process of building value, but marketing value is fine. That's what is quite interesting. Any one more quick question before I go in? Yeah, please go ahead.
Hi, my name is Vikrant. I'm representing Credible, it's a fintech firm. Actually offers vendor financing, supply chain financing. So Chirag, thank you so much for bringing this out. That's extremely important, and we're seeing a lot of traction from clients because they believe this is sort of helping them to cater to the ecosystem, which faced difficult times during COVID and even after that. Anyways, my question is, do you believe that Indian capital markets have the depth to absorb the IPOs of these startup companies? We have seen what has happened to companies over the last couple of years, right from Policy Bazaar to Paytm and Nykaa. Or do you think it's probably appropriate to actually look at NASDAQ and other platforms to list your businesses?
Do you want to take that, Arvind?
Yeah, maybe I take that. I think it's Indian market has a lot of appetite for new age businesses. As you saw in, let's say I took Nykaa public and spent a year after that. But when you do the IPO for new age startup, there will be a lot of FII interest, right? A lot of institutions, which are foreign institutional investors, that would be sort of setting the trend for your IPO. And when they look at India, they look at huge potential in terms of growth, because the penetration level are still very, very low. And even if you do an IPO listing in India, FIIs set the trend and they take maximum share of the book, anchor book and open book. So I don't think it does matter so much that whether you list in India or NASDAQ. I would rather think that if you are a consumer brand and you have a lot of customer affinity in India, it's better that you do it in India. Investors will anyway come. Most of the decisions on FIIs are probably made in Singapore, not necessarily in US. In fact, one of the listing that happened in NASDAQ, so even promoter came to Singapore roadshows afterwards, because if you list there are thousands of companies, and how many research analysts will track your stock, how many consumers would know about it. So it's better to list in India if it's a consumer story with affinity in India. That's my take. But over to other panelists.
Yeah, sure. So, you want to add, Abhinav?
Yeah. See, India as a landscape is changing. See, currently we are 3.5 trillion economy, and in next 7 to 12 years we'll be hitting 10 trillion economy. So so the country itself the stature of the country is rising. In the rising economy, if you launch your product, that will have more values than in any other country. And second thing here is, see, to build a consumer brand require at least 8 to 10 years. We all are in the process of building brand. To reap fruit will take some more time. See, Paytm as a product, really innovative. They penetrated the market completely. Everybody, but significant population of the country is using Paytm today. So these will take some time to generate profit, but brand is already built. Once brand is there, profitability will not take enough time. This is what I believe.
Sure. So let me get into my set of questions, and Rahul, I will bring you back here into the conversation. I was going through your profile, and I understand that you have raised more than $500 million in your previous avatar from the murky investors like Blackstone, TPG, Chris Capital, Alibaba, and something like that. So I always wonder, how does investors look at the investments? What do investors want? What do they think of while investing? Do they think of चल अर्ली स्टेज में डालते हैं, बाद में कोई दूसरा बंदा आके आ जाएगा, मैं एग्जिट करके निकल लूँगा, अपना पैसा बनाते हैं? Do they think like that, or do they think about the serious valuation? What is that dialogue that happens, and what exactly the investors want?
I think really very interesting question, Amol. So see, when we talk about the investment, you have different stage of investors. So if you are early stage who want to look at the company at very early stage when the product is maybe introduced or product is yet to come, but they invest. But many of the investors you will find who is pre-IPO investor who is a mid-age investor where they are looking at IPO in next 2 to 3 years. When we talk about the investors who are at the start, Series A investors, they normally look at the investment and they take a large bet where the product can be successful or not successful. But when you talk about the investors who comes in between, the growth investors, they always look at the market fit, where what is the size of the market you are trying to serve, whether the competitive advantage, who all are the competitors, whether the market is two-player market, three-player market, how the growing economy has the market in the same segment. These all things has to be looked by growth investors who looks at the growth in the company, invest in the company for next 2 to 3, 4 years, and then exit through IPO or any of the strategic sale route. But they are investors who come into pre-IPO. They are very short-term investors coming when they are very certain about the profitability of the company as well as the IPO timing, where they invest for a short-term investment, not very long-term, but pre-stage investors comes for 5 to 7 years, have a long-term goal for the company and gets a good return. So investors as a whole have different approach. While they take the fund, they have that manifestation in their mind that where they are going to invest. Sectors specific agnostics investors are also there who looks at various sectors. Some are not very fridgy about say logistics. Some are very much fan on the logistics who have seen the market in China as well as the US. So while we talk about our company, people has come for investors like TPG and Blackstone invested in the last round. So the entire round which we have raised more of secondary round where we gave exit to the early stage investors. But the goal and what investor has taken in us is more on the market size, because we all believe in e-commerce, entire ecosystem and world believe on e-commerce, the growth and CAGR of the e-commerce, because two large economy has seen the growth in the ecosystem and that how can be replicated in India as well. So with that long-term goal, people have invested in the company. Yes, valuation is very important because you have multiples on the exit EBITDA company is going to achieve. But yes, and the early years more because we are in the companies where we have scale benefit. So when we say about some of the consumer things, you have scale benefit where you have repeated customer, you make the infrastructure for serving a large ecosystem which will come after 2 to 3 years. But at the end of the day, yes, we do competitive benchmarking while investment, and as a whole, the goal is the profitability, but again, timing and factor is different for different investors.
Sure. Quite meaningful, Rahul. Abhinav, let me come back to you. And when does business value and business valuation intersect? And what are the areas that someone should focus on?
So Amol, as such, there's no one particular day or period when at till a day you are chasing growth, and from next day you are chasing profitability. It's like from day one, you should have clear charter ki what you want to achieve and how you will reach there. Timing can be different, it can be sooner or it can be later. But on day one, it should be clear how your product, what is your go to market, what is your profitability number, and how much contribution margin you will be generating after selling the product. In our company, we made it very clear. Even if, see, whatever contribution margin you are generating, over and above, if you want to spend on marketing or technology, then you have to give us a reason what will be the outcome of these spend. If you are spending on marketing, then you have to have a commitment what growth number you are going to get. If you are spending on technology, then you have to give a cost efficiency or optimization number that you will be saving, or customer experience that you are enhancing. Ideally, that's the best way to scale a product. And in tough time like we have witnessed last year, even without capital, you can survive for a longer period. I believe that's the best thing. And second thing, see, always raise capital to expand your horizon, not to run the business. So when I joined the company, we were doing 5 crore business a month. I could have made that business profitable, but the idea was to ensure we capture significant pie of the market. Of course, with scale, the unit economics keep on improving. But today at 1000 crore, we are fairly profitable. So scale will give you some benefit, but certain benefit should be in place on day one. Your scale will not multiply your losses over a period of time. That's the most important thing.
Sure. Noted your points, Abhinav. So, Arvind, maybe not a direct question, but just a thought. And what Abhinav said is a very clear picture, or maybe that's a fundamental value, but everybody is not looking at it, right? When Paytm got listed, or when they disclosed their DRHP, everyone compared Paytm with Tata still, because the value of both the companies were same. But Tata had large and many assets than Paytm could ever show, right? So what makes this startup inflate their value? Because I still remember one of the founder whom I know very well and asked him, why don't you show your profit? He says, because we don't make profit, we make losses, which we can't show, right? So most of these people, for example, if they are raising 500 crores, 1000 crores, and losses are more than that, double than that. So what makes them just inflate the value? Why the value is really high of the startups when they are not making even 0.1 basis point of profit?
No, it's a tricky question. So first I'll make a disclaimer. My views are personal. Okay. No, I think you need to look at these new age companies little differently. And, the tech-driven businesses, and I talked about it, that performance and potential, right? So performance is what you see as a history, and most of the traditional businesses which have consistently performed, they are loved by investors. But potential is equally important. And many of these new age businesses, they are at lowest, they are kind of creating a new market. And probably in that sense, valuations are also shifting, from the traditional businesses to new age businesses. Let me give one example. The traditional businesses and very respected listed FMCG companies, right? They have built their strategic moat on distribution. They reach to the depth of the country, and they have a three-tier distribution of wholesaler, distributor, retailer, right? So that becomes a strategic moat, and it's a barrier to new age company. But through the technology, this barrier has been removed. For example, let's say Nika, it reaches 98% pin codes, it delivers in 3 days. And because of that, there are thousands of D2C companies which have cropped up, and they leverage this technology to reach these consumers, in a very cost-efficient way and very scalable way. So, it's bound to happen. So, because of the new age and use of technology, valuations are shifting from traditional businesses to new businesses. That's one justification. The second justification is many of these businesses, like Abhinav mentioned, that I'm not taking capital to run the business, I am taking it to grow the business. And these businesses are essentially very asset light, right? They don't have very capital intensive business model. So their NAV is always bound to be very low because they don't have big plants, factory, they don't need it. They are coming with a different approach to the business, and they are OPEX heavy. They spend a lot of money on technology, they spend a lot of money on marketing. Our accounting standards don't allow us to capitalize the intangibles, but they have enduring benefit for long term. If you create a consumer franchisee, a lot of money goes into building that. It's booked as an expense, as in a marketing, right? So initial years you are bound to be in losses. But if you have an eye on unit economics and you become profitable, then at some point in time you will generate ROCE or ROE, which is actually much better than traditional businesses, maybe 5 year out. And one needs to understand this business model to be able to justify the valuation. Finally, I think, how do we sustain valuation? And I'm speaking a lot, but I'll try to simplify it through a jargon because I worked long in telecom. I call it 3G model. Initially, I used to call it 3G model. Now I call it 5G model. The 3Gs are growth, profitable growth, sustainable growth. And growth means that how big is your market, right? What is your TAM? What level of penetration are you? Do you have right product market fit? Are you getting the right set of customers into your product being sold? Profitable growth is about every next unit that you sell or every next order that you generate. Is it adding to the bottom line or not, right? So the marginal equation of earnings versus revenue, is it getting better or not? So that's about unit economics. Sustainable growth is about winning the customer heart, right? So are you building the cohort where customer will keep coming back and doing a repeat purchase? Are they growing their consumption? You can measure it probably through NPS or customer satisfaction scores also. So that's how you make it sustainable. In fact, investing into talent is important to make it sustainable. If you don't retain your talent, how long can you continue to grow? Similarly, investing into technology is equally important because you have to be ahead of your peers. So all of this makes it sustainable growth. Now let me explain the 4G and 5G. The fourth G is responsible growth. And we heard about ESG a lot from the previous panel. I think it's very important that business is also conscious of environment effect and the impact on the governance, right? So those are very important. If you have warehouses and if you don't give a good working conditions to your employees there, someday it is going to blast on your face, right? We have heard about Amazon valuation getting impacted overseas because of that issue at some point in time. So, it's important that you build sustainable model and have good governance practices. Finally, inclusive growth, which is about having the diverse talent on the board, in the management team, in the execution team. So are you building it in a manner that people feel part of the organization and you build a right culture? And also in the ecosystem that you operate. So for example, are you enabling the SME ecosystem? Because then you're part of the overall economic growth. Let's say we are enabling UPI at PayU, right? Every fintech is doing that. But through that, we are improving the financial inclusion in the country. So that part is the inclusive growth. I think all five are important. And in the long term, that's how you create sustainable valuation, which is what companies like HDFC has done. And that's why every investor loves HDFC. So to sum it up, 5G.
Sure. Interesting 5G
Just,
model. Yeah.
sorry, just want to add one thing here. I'm not sure you might have heard about PayPal, but PayPal started with giving $20 for every customer who was onboarding on PayPal platform. And people doubted whether they will make money anytime or not. But today, they are $85 billion company. And at peak, they were more than $150. So, see, it requires some time for product to get the landscape, to get their platform. And over a period of time, once that is done, they are certainly make significant amount of profit and give beautiful return to the investors.
Sure. Noted your points. I think the time is up. I had one more important question, but I will stop here and allow the lady in the front to ask one question. She has been asking me to. Can we have a mic there? Or okay, you can take this mic.
I have one here. Thank
One
you
quick
very
question.
much. Yes, a very quick one. I think he alluded to it a bit. I was saying, in the midst of this value and business valuation, which one should we focus on, marketing or technology? Simple.
So building value versus business valuation, which one should focus on? Marketing or technology?
Businesses should focus on which one should we invest in, marketing or...
So as an investor,
Yes,
as an investor, where they should,
as a company.
as a company, as an investment company, where they should invest. I mean, all of them will say invest in their companies. That's fine, no doubt about it. But Arvind, you want to take that? Where should you invest?
Yeah, actually, this dilemma is there every time when we do the budgeting exercise and allocation. I don't think you can choose one over other. Both are equally important. Technology is important because you need to keep your products ahead of your competition, and you need to invest into tech talent. It's not like turn on and turn off kind of thing. It takes years to build great products, and therefore you need to invest into technology talent. At the same time, marketing, and that's again important because if you have found the product market fit and you want to scale it, you have to rightfully invest into marketing either through traditional media or digital marketing, depending on the business model. So I don't think one can be ignored over other. In the long run, ideally, if you have done the right product market fit and right technology investment, marketing cost should come down. Because that means that you have not really thrown discounts and got temporary set of customers. You have really built customers who will keep coming back and doing a repeat purchase. For example, in Nykaa, 75% of their sale was coming from repeat customers. And that's fantastic. It shows customer love for Nykaa brand, right? So the investment that they made in marketing is paying back through the return of customer and repeat purchases. So over time, you will see a significant leverage in marketing costs if you have built it right from the customer point of view.
Sure. I think Rahul also wants to add.
Just to add on the technology bit, if you see any of the growing company in the startup space who are solving the problem, the premises of investment and the people look at is the technology. So that's the first start for any of the investor. If they come, first start is the technology, because the entire premises of valuation, creating value, is how you can scale the business with low fixed cost. And that's the reason each of the startup you talk about is a very light in terms of capital, and that is because of the technology. So technology is the must to have. Marketing enhance the revenue for the company, but technology is something which is going to have the scale in the business.
Sure, I think that was quite meaningful. Thank you for your questions and listening to us very patiently. Thank you for Rahul, Chirag, Bittu, Abhinav and Arvind for, must say, interesting insights here on building valuation. I hope your journey towards building valuation goes, accelerates more, and, see you the better returns there. So thank you so much for sharing those views, and thank you so much for listening to us very patiently.